Welcome back to Financial Understanding, Finance for Understanding. Today, on this second part of investing series, I'm going to discuss upon all the importance of investing broken down by categories and the importance of understanding risk in investing. Last episode, if you didn't watch, I highly recommend to go watch. I talk upon all the basics of investing and all the important fundamentals. What does risk mean? So, obviously, for one, risk entails a lot of negative connotations when you think of it. It's like risk, a lot of bad things. Anyways, what is risk with investing? It's just like the risk reward, which is a common phrase, meaning the money risk with a given investment equals normally the higher chance of return. So, like, for example, a lot of risk things, which would mean like crypto and stuff like that, I'm going to talk about like on and with an investment sense, what it means. Broken down, risk is, let's just say, I love using this example. You go into a casino, it's like you're risking, which is you're gambling, sports betting, stuff like that. And that risk reward factor plays a prominent role even in investing. So the risk triangle. So we'll start at the top, which is higher risk is on the top, which is growing companies, startups, crypto like Bitcoin, all that fun stuff. And in the middle section of your triangle, it would be real estate, more established stuff. ETFs like the S&P, the Dow, like all these things that are a little risky but not like super that's not super volatile, which is a phrase that I might be throwing out a lot because it's the fluctuation of something and the chance, it has to go up. And then, so on your low would be bonds, cash, money markets, things like that, have close to no risk, like fixed income, treasury bonds. I want to discuss upon how do you know your risk tolerance. So there's three pillars that I'll talk about today. So your financial position, for one, what your financial, how, if you have enough to invest to put away, you could put it into a index fund. That's why it's very important to break down in like your numbers in a budget or a monthly spending plan. I have an episode on that, and I highly recommend you go listen to that one. That's very important. That's essential, because if you don't know your numbers, budgeting and that stuff, I would say, is number one, and your savings, and then investing, because then you could build off that wealth, and then it could excel you, because you need to know where the money's going. And then if you're like, okay, I'm gonna invest this money, and it's like, where's it going? If you have things to pay, then you need to pay that first, and you need to be consciously aware. Number two, your age. So if you're younger, typically you have the ability to invest, and that means you'll be able to go out compound making more money after 30 years. I think that's where it really starts. The bulk of the money starts getting made. And obviously retirement, because let's just say X date you want to retire. If you're older, your risk doesn't have to be as high. And like if you're a little more risk tolerant, able, and it doesn't affect you as much, then that's fine. And the reward factor, obviously we touched upon this a little bit. The higher it goes up, then the more you're going to make, obviously, and the longer time it sits. Investing is not supposed to be pretty, okay? Investing is not supposed to be this like pretty thing. The longer time duration, the more typically, it compounds and builds for whatever it so be. And then now I want to break down by category. So I want to talk about real estate, and I want to talk about like the stock market, and like breaking how these things work. If you're like, no, what is the stock market? What's an index fund? I'm going to break it down, and I'm going to talk about all of the key components needed, the returns and all that stuff. And I'm going to talk about fixed income too. And I'm going to break down, you'll want to say to the end of like, what are good index funds? You've heard me throw around the term like the S&P 500, the Dow Jones, and yeah, I'll talk more upon this. But first, let's start with real estate. Who doesn't really like real estate? You're like, I got to buy a house, I got to buy. Renting's not bad, but that's a whole different thing. So average real estate return, ROI, like I said earlier, return on investment. It's a great term. Very high level. You learned a financial term, which is great. Anyways, in our improved significantly in 2024, bringing a 10-year yield and now annualized returns up to 4% from iPropertyManagement.com, which it's like hard to calculate depending on where you are. Places like in Los Angeles cost a lot more than I would say in a rural place in the country. Here's a quote from Investopedia.com. The S&P 500's historical average is 10% annual return, including dividends, outpaces housing typically between the range of 4 and 8% gains. But these numbers need to be put into context. So with housing or real estate, I'm going to list some like pros and cons to including is like less volatile because you have that and you have that physical asset property. You could live in it and all that stuff. And often purchase using leveraged debt with real estate. Typically you have to put a 20% down payment with real estate and higher management costs. If you have to repair a roof, you often don't really factor those costs in, but you don't really account for them. Rental income is treated as ordinary income. Rental income gets added to your income. So let's just say you make $50,000 for a salary. That income, like let's just say you make it off a rental property, that gets added to that. And then the whole tax thing is something like it's not completely separate. I'm not going to go into further explanation on that. But I do want to talk about rental properties a little bit because it does go under that real estate category. So according to Bankrate.com, there are 19.3 million rental properties in the U.S. 85% of them containing at least one unit. In total, there are 49.5% million rental units. U.S. Census Bureau. And here's another thing. Rental properties are largely owned by individual investors, 70.2%. This shows you basically how investors, it's a great source of investment. You can rent out that property and it speaks for itself. You get an income and all that stuff. Now I want to move on to fixed income. What is fixed income? What is it? Fixed income is a fixed interest or other regular payment to investors holding the securities. A fixed income is like bonds, for example. I'll talk about like treasury bonds. So a treasury bond typically mirrors off the Federal Reserve. Right now it's about 4-ish%. 4.3-ish. I think it got the high in the pandemic, which is like 5% because the federal rates have been high coming off the pandemic. Here is a graph showing the interest rates over the past like couple of years. As you can see here, it's now like 4.3. So yeah, it's just like that 4.3. It hovers over whatever that interest rate is. These typically don't have as much risk. It's like, it's good and stuff like that. A money market mirrors off that to a high yield savings. I think typically a good high yield savings might be 4%. You just have to look for that because as I've said before, a savings account a traditional one doesn't really pay that much interest. It typically is about like 0.0 like 1 or something. Like you get like a couple cents every like month or something, which isn't that much. Okay, now let's talk about the stock market. So the stock market in detail. So the stock market, I want to first by talking about regular stocks or stock picking. Stock picking where you pick the stocks yourself. You want to buy like Apple, you want to buy Microsoft, you got to buy that startup, which would be in the high risk triangle, the top one of the risk triangle, more risky. So buying a stock picking is risky. According to motleyfool.com, yeah, the average investor had an average annual return of 2.9% in 2020 when this thing was published for, and basically the S&P 500 had an average return of 7.5% from 2001 to 2020. There's a rough statistic out there. It's like 7 or 8 traders lose, which is not good. Investing, you're just supposed to set it and leave it, and then just like let it ride the compound wave. And then, so dividend stocks is another type of stock. So a dividend stock, so whenever you see a dividend, so like let's just say you go into the stock app on your phone, and it might say like a dividend yield. What that dividend yield means, you get whatever that percentage, let's just say it says 3%, that's how much you get back. So like if it was just a regular stock, for example, I think Starbucks pays 3-ish% dividend, or like you might have some index funds that pay dividend, like dividend stocks. A dividend stock would be the ticker symbol SCH, Schwab's, which I think is SCHD. So yeah, that's a good one. I think it's like 3%, and then a lot more of those like established companies like Coca-Cola and stuff like that, they pay a dividend yield too. So now let's talk about index funds, which is I've been waiting to talk about index funds. They're so great. So, or an ETF, which an exchange traded fund. So it's a basket of, I was saying earlier. So imagine you have a basket and you have companies. You're going shopping and you throw and you're throwing things in the basket. So that's pretty much an index fund. So it's managed by agency or whatever. That's kind of like a mutual fund too, but these are just like the expense ratios are a little bit less. An expense ratio of a mutual fund might be like 2 to 3% because they're more like monitored. But an ETF, for example, an index is you have that basket of stocks. I'm going to name 3 very common ones that are tracked: the Nasdaq, the Dow Jones Industrial Average, and the S&P 500. So the Nasdaq 100, it tracks the top 100 like tech companies pretty much on the Nasdaq, which is a stock exchange. The 2 biggest one here in the US are the Nasdaq and what's the other one? The New York Stock Exchange, which the New York Stock Exchange typically has more, those other type of companies, and the Nasdaq's more tech focused. The Nasdaq, according to Curvio.com, typically averages like 17% over the past 10 years. The more you go back, the lesser, it makes kind of thing, because basically it was like that. Yeah, you just have to look at the returns. That's how much it's average. The Dow Jones, according to the wealthspire.com, the Dow Jones typically returns 8.7% each year, which is a pretty good one. It typically tracks, what it does is the top 30 companies, and they're pretty much like established companies. Like you have like Home Depot and their Apple. So it's a little bit less movement typically. And then our last one that we'll talk about is the S&P 500. This one refers to, when people say this, Standard & Poor 500 is what it stands for. It tracks the top 500 companies. And so this one typically referred to as the overall market. And the Magnificent Seven typically makes up 20% of this portfolio, which is Apple, Nvidia, Amazon, Meta, Alphabet. Forgetting 2 more. I'll put on the screen. Did I say? Yeah, I forgot. And that's by market cap. I'm pretty sure how the S&P 500, in order to be in it, you have to have, they look at your earnings. Stocks are reported 4 quarters. Here's a little how it works. Bonus lesson. And you have to have a certain amount of positive earnings to be put in the S&P 500. That one tracks the overall market, and the average return on that, according to TradeThatSwing.com, is 10.569% each year, historically over a 100-year period, which is crazy. That's like hard to beat. For example, I mean, you could put more tech focus, more volatility, but yeah, it's just, you just put it in there and you just see what happens. And And then crypto, it's more volatile. I'm not going to go into that with too much detail, but it's highs and lows, with crypto. But yeah, I think it'll continue to go up. Next episode, we'll talk about this more in detail and how you actually apply these things. You'll definitely want to stay tuned for that one and check that one out, because you'll be able to be guided on how you actually use this information. And so yeah, thanks for watching. I hope you enjoyed, and please consider sharing. And yeah, have a great rest of your day.